Now, we have been expecting serious ramifications, financial and other ramifications, because of this monetary policy. And we've gotten the first one, but most people here in the United States are not aware of it or haven't thought very carefully about it because it doesn't seem to matter. But I was in the UK around the time that it had its near Lehman moment. Near Lehman moment means the financial system implosion. And that was just about 10 days ago. Now, what do we mean by that? Well, there is something called LDI, liability-driven investing, and it's where pension funds match their liabilities with assets. So they will, in its pure form, they will match one for one the amount that they have to pay out to pensioners as they retire. Now, it would be great if they did match assets with liabilities completely from a safety to the system point of view. But they don't, and with banks, and a very low interest rate environment, they got used to using derivatives and taking shortcuts to try and accomplish the same goal. And after a very long period of very low interest rates, I heard someone say the other day, and we were talking about this LDI crisis in the UK, that the reason it's so serious is pension fund sponsors were beginning to think, and banks were beginning to think, that interest rates would stay very low for a very long time, for as far as the eye could see. And that assumption was built into the kind of derivative activity they were doing. No one expected a sharp increase in interest rates. Well, once that happened, pensions began getting margin calls, and they couldn't meet them. And in fact, if interest rates had gone to 8%, and I think they got to 6% over there, if they got to 8%, then according to some of the people close to that situation, whom we have consulted, then the pension system would have collapsed. But it wouldn't really have been the pension system. What really would have collapsed if the pension funds were not meeting those requirements were the banks, the counterparties in this case, for these derivatives. And so the Bank of England had to step in and basically say pretty much the same thing that Draghi said, the chairman of the European Central Bank in 2011. He basically said, we're going to pull out all stops no matter what. So while the BOE had been almost forced because of currency depreciation into following our Fed with higher interest rates, this was going to cause a great deal of harm to its system, and so it had to reverse its policy. So this is another reversal in policy, or it's a bit of a shift in policy. It's an outright easing, and they said they will continue until October 15th. So now all of these pension funds, in collaboration with the banks, are deleveraging, and they have till October 14th. So what do you do if you're deleveraging in an illiquid environment? All markets are experiencing duress today. I think the Fed is a big part of that. So what do? You sell the most liquid assets. What are those? Those are government bonds. And so we're seeing U.S. government bonds, which are held in pension funds abroad, being sold, even though deflationary pressures are mounting all over the place. And so we think this is a bit of a financial crisis, and we think we'll see it elsewhere as the Fed continues to raise interest rates, as it seems want to do. Certainly this week was full of speeches from all the Fed members reminding everyone that they're going to take interest rates up until we get to 2% inflation. Well, so we'll see what happens on October 14th. By that time, I think they will have been deleveraged and will be past the maximum pressure associated with this guilt trip, which is why we called this in the note. We're seeing other changes. We've seen China intervene to limit the weakening of the yuan. We've seen Japan doing the same. Now, what is that? What are they doing when they do that? Well, when Japan is trying to support its currency at 145 yen to the dollar, what it does is it sells dollars and buys back yen. Now, that's good in a way. It's doing some of what the Fed should be doing here, actually. It's providing dollar liquidity to the rest of the world. China is doing the same thing. And so we'll see what happens from here. I think this is getting to be so serious that we are reaching a cathartic moment, and I do think it started with the guilt trip. And the Fed has acknowledged that there are international ramifications to what it is doing, but it is thinking first and foremost about the U.S. This reminds me a lot of the early 80s and what happened in the early 80s. There were two accords, the Louvre Accord and the Plaza Accord, where the Treasury ministers around the world all agreed to sell dollars to limit the deflationary impact on the rest of the world. And when I say deflationary impact, there are countries, sure, their currencies are falling apart, so their inflation rate they look like they're in hyperinflation or heading in that direction. But they are being strangled by dollar-denominated debt that they cannot service. And so this ends up being quite a deflationary situation longer term. And so we're wondering what in the U.S. is the weak link. Is it our pensions? We don't know. We know there are LDI strategies in the United States. They're not as leveraged as we understand, but one never knows. Well, if not that, what are some of the weak links that we're seeing? We've been worrying about auto credit for a while now, and now we have more reason to. Yesterday, we got the Mannheim used car index. It's a value index, pricing effectively. And it dropped another 3% plus. It was 4% plus decline last month. And so what we have now is it has the year-over-year increase has gone from 54% in April of 21 to minus 0.1. So there you go, Fed. There's some indication that there's another indication that deflation is in the system.